In this video, we will do a discounted cash flow calculation. We will use Caterpillar as the test company. To get to the discounted cash flow, or DCF, we select Research from the home page and Valuation from the submenu. We see Discounted Cash Flow is the second menu option for the valuation submenus. We can click the triple and double arrows to minimize those submenus and provide more room on the screen. The discounted cash flow calculation uses a forecast that we previously did and a cost of capital that we've calculated, or we have some pre-calculated values for testing purposes as well. In this case, we will select Caterpillar from the three companies that you see that we've done some previous forecasting for, and we will select the WACC value of 5.45, which we've previously calculated as well. As we said, you can use the pre-calculated if you prefer. So these two inputs will allow us to generate a discounted cash flow for Caterpillar. Discounted cash flow is a fairly complex calculation, the essence of it being that we take a forecasted cash flow, 2014, 2015, 2016, and beyond, from a forecast that we've done previously. We apply any normalizations or adjustments that we think are appropriate to that cash flow to come up with a normalized EBITDA or normalized cash flow. EBITDA being earnings before interest, taxes, depreciation, and amortization. We apply the tax rate that's appropriate for the company based on the financials, remove those taxes, and we have a net operating after-tax cash flow that's generated. If there's capital investment required for the company, we can input it at this time and calculate the tax shields that would occur on that capital investment. The same is true if any working capital requirements or any incremental working capital requirements are needed. All of this calculates into a discretionary cash flow, which we then can discount to the present time. So we will actually calculate the discounted cash flows. We have a cash flow here, if we see 6 billion, it looks like, discounted on our weighted average cost of capital of 5.45 to give us a discounted cash flow of 5.7. In year 2, again 5.7. In year 3, 6.3. And then we do a calculation from years 4 and beyond, so 3 plus. The cash flow, the terminal cash flow that you see here, is actually multiplied by the inverse of the WACC to come up with the cash flow that we expect for years 3 and beyond, or years 4 plus. We add these up to give us a total enterprise value, so the total value of the firm, which is the value of the debt and equity of the firm. We remove any interest-bearing debt that the company has. We take this from the balance sheet. That gives us an en-bloc fair market value of the equity. If there's preferred equity, we would remove that to come up with the value of the common equity. We then divide that by the number of shares outstanding to come up with a calculated value per share. This tool is very powerful because it allows you to play around with different cash flows, tax rates, and costs of capital to see what impact they would have on the share price.